Welcome to the deep dive. Today, we're tackling something really fundamental, revenue. Now, booking revenue, saying you've made money from a sale, seems like it should be the easiest thing a business does. But if you've ever looked closely at the accounts of, say, a tech company selling software plus services, or a big construction firm, well, you realize the rules are complex. We're talking about IFRS 15, revenue from contracts with customers. And it's definitely not straightforward.
No, it really isn't. And that's why we're doing this deep dive. Our source material lays out this global standard, a 5-step approach everyone has to use. It dictates when you recognize revenue and how much. And we'll get into some of the trickier bits too, like bundled sales or those agreements that aren't quite what they seem.
Okay, so let's unpack this 5-step framework.
Yeah.
It's sequential, you said, meaning you have to do them in order.
Exactly. Can't skip ahead. Step 1, identify the contract with the customer.
Okay.
Step 2, identify the separate promises you're making, the performance obligations or POs.
Right.
3, figure out the transaction price.
How much money is involved?
Sort of. We'll see. It's more complicated than just the sticker price.
Yeah.
4, allocate that price across the different POs.
Split the pot?
Basically, yes. And finally, step 5, recognize the revenue when, or, importantly, as you satisfy each promise.
Okay, let's start back at step 1 then. Identifying a valid contract. What makes a contract valid for accounting purposes? It's not just signatures, is it?
No, not at all. The standard is quite specific. Both parties have to approve it. You need to know the rights and payment terms. It has to have commercial substance.
Meaning it changes the risk or timing of future cash flows.
Precisely. And crucially, it must be probable that the entity will collect the money it's owed.
Probability. That sounds like a judgment call.
It absolutely is. It's critical. Look at the Bono Co. example in our sources. They had a contract, $360,000. But then things changed for their customer economically. Bono Co. decided, maybe we won't actually collect that full amount.
So what happens then?
Well, if that probability of collection drops significantly, you actually can't even start accounting for the contract under IFRS 15. No probability, no revenue recognition, full stop.
Wow. So the whole thing can fall apart just based on doubting you'll get paid.
It's the foundation. If that's shaky, you can't build on it.
Okay. Moving to step 2. Identifying separate performance obligations. This is about breaking down the deal, right?
Yeah.
What exactly are we selling?
Exactly. You sell, say, a machine and promise a year of maintenance. That's not one thing. It's 2 distinct promises. Delivering the machine is one PO. Providing the maintenance is another.
And you have to account for them separately.
You do. And this step is also where we had a really key distinction. Are you acting as a principal or as an agent?
Yes. This seems to catch a lot of businesses out. What's the difference in terms of revenue?
It's huge. If you're the principal, you control the good or service before it's transferred to the customer. You're the main seller. So you recognize the full gross amount of revenue.
Like the total sales price.
Right. But if you're an agent, you're just arranging for another party to provide the good or service. You're like a broker or intermediary.
So you don't recognize the full amount?
No way. You only recognize your fee or commission, the net amount you actually earn for your service of arranging the deal. The cash might flow through you, but your revenue is just your cut.
The Hadrian Co. example illustrates this, doesn't it? They handle a $45,000 sale for someone else, Alpha, and got a 10% commission.
Correct. So Hadrian's revenue isn't $45,000. It's just $4,500 their 10% commission because they were acting as an agent. They didn't control the goods themselves.
That makes a massive difference to your reported top line, your sales figures.
Absolutely. It's all about reporting your economic activity, not someone else's.
Okay, let's dive into section 2, the money side. Step 3, determining the transaction price. You hinted this isn't just a list price. Why not?
Well, because contracts often include things like rebates, volume discounts, performance bonuses. That's variable consideration. The final price might change based on future events.
So you have to estimate that.
You often do. Plus, you might have a significant financing component if there's a long gap, usually over a year, between delivery and payment. You have to account for the time value of money. And then there's non-cash consideration and something that sounds odd, consideration payable to a customer.
Paying the customer, why would that reduce my revenue? Wouldn't it be like a marketing expense?
Usually not, unless the customer is providing you with a distinct good or service in return for that payment. Like maybe they genuinely ran an advertising campaign for you. Any cash you pay to the customer is generally treated as a reduction of the transaction price.
So it directly lowers the revenue you book from that sale.
Immediately. Think of it like an extra discount you had to give to secure the deal. The Golden Gate Co. example shows this clearly. They sold $4 million worth of goods,
Right.
but they also paid their customer, a big retail chain, $1 million. This was to help the retailer make changes to their stores to accommodate Golden Gate's products.
Oh.
Because that $1 million wasn't for a distinct service from the customer to Golden Gate, it was seen as necessary to get the $4 million sale. It effectively reduced the overall price. The sources show it reduced the net consideration by 5% across the whole deal. So when they booked that $4 million sale, they had to immediately reduce the recognized revenue down to $3.8 million.
Straight off the top line. Ouch. Okay, so once we've wrestled with the transaction price and nailed that down, we get to step 4, allocation. Splitting that price across the different POs we identified earlier.
That's it. If you have multiple promises, the computer and the support package, for instance, you have to allocate the total transaction price between them.
How do you do that fairly?
You use their relative standalone selling prices, or SSPs. What would you sell each item for separately? The Wadeco example is good here. Computer plus 12-month support bundled for $420.
Right.
Let's say the computer sells for $300 on its own, and the support sells for $120 on its own. Their SSPs are $300 and $120.
Which adds up to $420, the bundle price in this case, so no discount.
Right. So when the computer is delivered, boom, you recognize $300 revenue immediately. The $120 for support is deferred, recognized over the 12 months, so $10 per month.
That seems logical, but what if there is a discount in the bundle? Like the computer is $300, support is $120, but you sell the bundle for $400 instead of $420. Where does that $20 discount go?
Good question. IFRS 15 is strict here. You can't just slap the whole discount onto, say, the support revenue because it gets recognized later. Unless the discount clearly relates only to one specific item, you have to allocate the discount proportionally across all the performance obligations based on their relative SSPs.
So in my $400 bundle example, both the computer revenue and the support revenue would be slightly reduced to reflect that overall $20 discount.
Exactly. The Shinji-ko example confirms this. You spread the discount fairly, reflecting the price the customer actually paid for each component within the bundle.
I can imagine the debates about what the true standalone selling price is for some of these things.
Oh, absolutely. It requires significant judgment and estimation, but it forces transparency.
Right. Which brings us to step 5, the culmination, recognizing the revenue. When do we actually book it? You said it hinges on control.
Control is the absolute key. Has the customer gained control of the asset or service? Can they direct its use? Can they get substantially all the remaining benefits from it?
And how do you tell if control has transferred?
There are indicators. Does the customer have legal title, physical possession? Have they accepted the asset? Do they have the significant risks and rewards of ownership? Do you have a present right to payment? No single indicator is decisive. It's about the overall picture.
Okay. This seems most relevant for some specific, tricky situations. The sources highlight a few, like consignment stock.
Yes, consignment. Let's take the Frood Motor Co. example. They send cars to a dealer, Dusty. Dusty holds them and sells them to end customers. Why isn't Frood recognizing revenue when the cars arrive at Dusty's dealership?
Because Dusty doesn't really control them yet.
Exactly. In the example, Frood can demand the cars back anytime. And Dusty can return them without penalty if they don't sell. Dusty is essentially just acting as a warehouse or agent for Frood.
So Dusty doesn't have the risks and rewards, can't really direct the use freely.
Right. Control hasn't passed to Dusty. So Frood keeps the cars on its books as inventory. Revenue only happens when Dusty sells the car to the final customer, because that's when control truly transfers from Frood's perspective.
Got it. Okay, trickier still. Repurchase agreements. This one feels really counterintuitive. Argene Co. sells inventory for $1.5 million.
Cash in the bank, inventory gone from the warehouse.
But they have the right, or maybe even the obligation, to buy it back later for $2.2 million. Right. And you're saying this might not be a sale at all.
Correct. Look at the economics. Why would they buy it back for so much more? That $700,000 difference? $2.2 million, 25 meters looks an awful lot like interest, doesn't it?
Like they borrowed $1.5 million and are paying back $2.2 million.
Precisely. Because the repurchase price is higher than the original selling price, IFRS 15 says this is effectively a financing arrangement. It's a loan secured by the inventory.
So our Jane doesn't recognize revenue.
No revenue. They don't even take the inventory off their balance sheet. They record the $1.5 million cash received as a liability, a loan payable, and they recognize finance costs, interest expense, over the period until repurchase.
That's mind-blowing. The substance, it's a loan, completely overrides the legal form of a sale.
Substance over form is a core principle here. They haven't really given up control if they're obligated or have the right to get it back, especially at a premium.
Okay, one more tricky one. Bill and hold. I sell something, I bill you for it, but I keep it in my warehouse for you. When do I recognize revenue?
This is possible, but under very strict conditions. The customer, Marco, in the Johann Marco example, must have requested the arrangement. The product has to be identified as belonging to Marco, ready to ship, and Johann can't use it or sell it to anyone else.
Seems reasonable. What's the catch?
The catch often involves the storage Johann is providing. Is that storage service significant? If Johann is storing these parts for Marco for, say, 2 years as a key part of the deal, then Johann is still performing a service.
Meaning the performance obligation isn't fully satisfied yet.
Exactly. If the storage is a significant service in itself, control hasn't fully transferred just because the goods are sitting there labeled Marco. But if the storage is considered insignificant, maybe just holding it for a short agreed period and all the other criteria are met, then Johann can recognize the revenue for the parts immediately, even while still holding them.
Fascinating how the nature of the storage service changes the revenue timing for the actual goods.
It all comes back to whether the seller's job is truly done regarding that specific promise.
Let's switch gears slightly to revenue recognized over time. This is common for long contracts, right? Construction, long-term services.
Yes, revenue gets recognized over time if certain criteria are met. For example, if the customer receives and consumes the benefits as the entity performs, think of a cleaning service or a subscription. Or if the entity's work creates or enhances an asset that the customer controls as it's being created, like building a custom machine on the customer site.
And if you are recognizing revenue over time, how do you measure how much to recognize each period? How far along are you?
Good question. There are two main approaches, input methods and output methods.
The input methods, like costs incurred.
Often, yes. You look at the costs you've incurred to date compared to the total expected costs for the whole project. If you've spent 50% of the expected costs, you might recognize 50% of the revenue.
And output methods.
That's based more on, well, the output, the value transferred to the customer. Things like milestones achieved, units produced, or maybe square feet completed on a building, or often work certified by an independent surveyor.
So you choose the method that best reflects the progress.
Right, the method that best depicts the transfer of control over time.
Now, this leads to maybe the starkest rule in IFRS 15 dealing with contracts expected to make a loss.
Ah, yes, the cruel prudence rule, some might call it.
What happens if a contract is profitable, like Baker Co.? You just recognize profit based on the percentage complete, right? 50% done, 50% of expected profit booked.
Correct. Profit recognition follows revenue recognition based on progress. But if you determine that the entire contract is going to end up in a loss...
Like Castle Co. expecting a $2 million loss overall on their $10 million contract.
Exactly. If you foresee an overall loss, IFRS demands that you recognize that entire expected loss immediately, right now.
Wait, the whole loss, even if the project is only, say, 50% complete?
Yes. The full expected loss must be provided for as soon as it becomes probable. You still recognize revenue and costs based on your 50% progress, but you also book an immediate provision expense for the entire anticipated future loss. In Castle Co.'s case, that's $2 million hitting the income statement straight away.
You can't smooth it out over the rest of the contract.
Nope. Bad news travels fast in accounting. You cannot defer a known loss. It's about prudence and not overstating profits or assets.
That really underscores that financial reporting isn't just about matching current revenues and costs, but also about forecasting and risk assessment.
Absolutely. It forces companies to be realistic about unprofitable contracts early on.
So, stepping back from all these details, what's the big picture? What should you, our listener, really take away from this complex standard?
I think the main thing is that IFRS 15 forces a really disciplined look at the economics of a transaction. It's constantly asking, have we really transferred control? Are we the principal seller or just an agent? How variable is this price really? And are we potentially facing a loss here? It shows that just looking at cash coming in the door doesn't tell you the whole story about a company's performance or financial health.
Yeah, the complexity around variable pricing, bundles, and especially that immediate loss rule. It highlights that true financial reporting is about estimation, judgment, and, well, prudence.
Definitely. And think about that repurchase agreement. Again, Arjun& Co. Cash received, goods shipped. But because of the repurchase price, boom, it's not revenue, it's debt. A non-current liability appears purely based on the pricing terms. Substance completely dictates the accounting.
So the next time you look at the financial statements of, say, a big tech company selling phones with service plans, or a major construction firm, remember this five-step process is working behind the scenes, meticulously dissecting every contract to figure out the real revenue story. It's about much more than just the sale itself.